and welcome to this episode of Legal Wrangle on domestic and international taxation. Today we are covering 3 Supreme Court decisions relating to treatment of tips earned by hotel employees from its customers, availability of exemption to an educational institution, and validity of stay on special audit for determining limitation period for block assessment. Then we will be focusing on other decisions relating to reopening of assessment on the basis of base note addition of cost incurred by AE to assessee's account for determining ALP, need to aggregate books of accounts for computing deduction under section 80 HHAE and applicability of advance pricing agreement in absence of rollback provisions. Today we start with the division bench decision of Apex Court, where the key issue is whether the tips earned by a hotel employee from its customers are chargeable to tax under the head salaries under section 192 and any obligation to deduct tax at sources arises. The assessee is ITC Limited Gurgaon, engaged in the business of operating managing hotels. Now let's go to Mona Lisa for details of the case.
During the relevant year, surveys conducted at the business premises of the assessee revealed that they had paid tips to their employees without deducting TDS. During assessment, these receipt of tips were treated as salaries in the hands of employees, and the assessee was treated as in default for not deducting TDS from such payments under section 192. This assessment was confirmed by the High Court by observing that tips would amount to profit in addition to salary or wages.
The Apex Court concluded the matter by observing that the income from tips would be chargeable in the hands of employees as income from other sources. Such tips being received from customers and not from the employer do not attract the provisions of section 192. The Apex Court therefore held that tips being purely voluntary amounts which do not allow vested rights to employees would not therefore fall within the purview of section 15B at all. Thus, there is no obligation to deduct tax at source. In our next Supreme Court judgment, the key issue is whether when assessee has generated huge surplus but got small amount of grants from the government, collection of fees prescribed under law can be construed as grants by the government to be entitled to exemption under the IT Act. The assessee is Vishweshwarya Technological University, which exercises control over all government and private engineering colleges within Karnataka. Now let's go to Mona Lisa for details of the case.
The assessee, being an educational institution, claimed exemption under section 10(23)(c), which was denied by the assessing officer, and his view was upheld by all the authorities under the Act, including the High Court. Also, notices under section 148 were issued to the assessee university.
The Supreme Court observed that during a short period of a decade, the assessee has generated a surplus of about Rs 500 crores. There was no doubt that the huge surplus has been accumulated by realizing fees under different heads in consonance with the powers vested in the university under section 23 of Vishweshwarya Technological University Act 1994. The difference between the fees collected and the actual expenditure incurred for the relevant purposes was significant. The Apex Court also observed that the funds received from the government contemplated under section 10(23)(c) must be direct grants from governmental sources and not fees collected under the statute. But in this case, the assessee university is neither directly nor even substantially financed by the government so as to be entitled to exemption from payment of tax under the Act. Therefore, the assessee cannot be granted the exemption as contemplated under section 10(23)(c). In our next Supreme Court judgment, the key issue is whether the period during which the special audit under section 1422A is stayed by an interim order of the High Court can be excluded while computing the period of limitation for carrying out block assessment. The assessee is VLS Finance Limited, engaged in rendering financial services. Now let's go to Mona Lisa for details of the case.
During the relevant period, The SSE was issued a notice under Section 158 BC and was directed to furnish its return for the block period. However, even after compliance of such direction by the SSE, no block assessment was carried out. Later on, a direction under Section 142 2A was issued for conducting special audit in relation to block period. Although such special audit was stayed by the High Court, the SSE claimed the block assessment as time barred by contending that order passed for stay of special audit would not qualify as stay of block assessment for purpose of computing limitation period for carrying out block assessment.
The Apex Court observed that where stay of some other nature than the stay of the assessment is granted, but the effect of such stay is to prevent the AO from effectively passing assessment order, even that kind of stay order may be treated as a stay of assessment proceedings. The Apex Court therefore concluded the matter by holding that since special audit was an integral step towards assessment proceedings, an order passed for stay of special audit would qualify as stay of assessment proceedings, and such period of stay is to be excluded while computing period of limitation for carrying out block assessment. In our fourth case, the key issue is whether initiation of reopening against a non-resident assessee on the basis of base note obtained by the French government under Indo-France DTAA indicating huge balance in a foreign bank account is justified in case the assessee is not ready to submit a consent waiver form. The assessee involved here is an individual who, though born in India, had migrated to USA on her marriage. Let's go to Mona Lisa for details of the case.
SSE has been filing its return of income in the status of a non-resident. Subsequent to assessment under Section 143(1), the AO received information in the form of a base note from the French government regarding existence of a HSBC account in Switzerland in the name of a company of which the assessee, along with her uncle, is a beneficiary. AO thus taxed the investment made in such company as unaccounted income under Section 69A, after which AO also sought to reopen such assessment by issue of a notice.
The High Court held that the assessee who has failed to sign a consent waiver form during the initial assessment proceedings is now ready to sign such form but with certain modifications. The court also held that at this stage, the modified form would not enable the foreign bank to provide copies of the bank statements which would give clues as to the source of amounts deposited in the account. The High Court further observed that the conduct on the part of the assessee and her uncle is not being forthcoming, leads to the conclusion that this is not a fit case where the court should exercise its extraordinary writ jurisdiction and interfere with the orders passed by the authorities under the Act. In our next case, the key issue was whether cost of goods sold by the AEs can be included in the cost base of the service or commission segment of the assessee for the purpose of computing ALP when the assessee has only rendered support services without incurring any cost in respect of such sales. The assessee is Mitsui & Company engaged in providing sales support and licensing services to its AEs with regard to the exports and imports of the commodities from its AE to or from India. Now let's go to Mona Lisa for details of the case.
During the relevant period, the assessee had entered into an international transaction by rendering sales support services to its AE. The TPO, however, included the cost of sales incurred by the assessee's AE to work out the profit for determination of assessee's ALP, for which the assessee has only rendered support services, which resulted in addition on account of TP adjustment.
The ITAT concluded the matter by observing that notional additions in the cost base of assessee by taking into account the costs which are borne by its AEs is not permitted. The ITAT therefore held that it is not open to the revenue authorities to reconstruct the financial statement of assessee by including the cost of products incurred by the AEs in respect of which services are rendered in its reconstructed financial statements and then putting the hypothetical trading profits so arrived at in these reconstructed financial statements to the test for determining ALP. In our second last case, the key issue is whether in case an assessee has maintained separate books of accounts, is there any need to aggregate accounts of all the business for computing amount of deduction allowable under section 80 HHE? The assessee is Global Telesystems Limited, which has earned export income from many business units, and one of its unit was engaged in the business of export of software. Let's go to Mona Lisa for details of the case.
The assessee maintained separate books of accounts for the unit engaged in the export of software and accordingly claimed deduction on the amount of profit as per its books of accounts of the export unit on the export turnover. AO held that as per section 80 HHE, all the businesses of the assessee have to be taken as one, irrespective of the fact whether separate books of accounts for each business is maintained or not. Therefore, the amount of deduction allowable under section 80 HHE should be computed on the basis of formula which computes the deduction on proportionate basis.
The tribunal held in favor of assessee and decided that as separate books of accounts were maintained by the assessee, there is no need to aggregate accounts of all the businesses for computing amount of deduction allowable under section 80 HHE. It had further held that as all the amounts required for computing deduction under section 80 HHE, its export turnover and its total turnover are separately available. Therefore, the deduction has to be computed on the basis of these amounts only. In our last case of today's episode, the key issue was whether advance pricing agreement entered into by an assessee with CBDT during previous assessment year can have impact in determining ALP of international transactions for subsequent assessment years as well. In case the nature of international transactions, FAR of assessee and the AEs are respectively similar. The assessee is Ranbaxy Laboratories Limited, engaged in the business of manufacturing and sale of pharmaceutical products. Now let's go to Mona Lisa for details of the case.
During the year, the assessee entered into international transactions with its AE, comprising of purchase and sale of APIs and dosage formulations, contract manufacturing services and market research and support services. For benchmarking such transactions, the assessee selected foreign AEs as tested party, relying on the APA entered by it with the CBDT during previous assessment year. Such selection was however rejected during TP proceedings on ground of geographical difference between the comparables submitted by assessee with the foreign AEs.
The ITAT concluded the matter by observing that the principles laid down by the CBDT under APA should be accepted by revenue at least for the purpose of starting the first step of comparability analysis when the nature of international transactions, FAR of assessee and its AEs as well as availability of data is on the similar lines as agreed in APA. Therefore, the ITAT directed the TPO to accept the selection of foreign AEs as tested party. Well, this brings us to the end of this episode of Legal Wrangle on direct tax. You may write to us your comments, criticism and counsel at editor@tioltube.com. Please do subscribe to TIOL Tube to remain updated. It's free and will keep you updated on our new posts. Have a good day.